I'm glad that the two of you guys get to be here. You know, I've had the chance to talk to both of you just being in the mastermind group and learn from both of what y'all are doing. So, Mike, I'll kind of kick things off for you. Just talk to about Excel Health Plans, how that was developed, and kind of where you started and how you got to here.
Awesome, thanks, Daniel. Yeah, we have a really interesting story at Excel Health Plans. Myself, I'm an ex-Division I college football coach turned benefits consultant. My mom is a primary care provider for a long time, and I noticed that there was something totally wrong with the healthcare system while working in her office doing lots of jobs. Started in medical billing, and what really sparked my interest in what's broken in the healthcare system was someone had a pacemaker put in that cost $600,000 because of a medical error. So it needed to be reattached, and during the reattachment procedure, the gentleman caught sepsis and was inpatient for a number of weeks, and thus the massive claim, which is, as you all know, is crazy overpriced. And that got me thinking, hey, what's up with healthcare? What's wrong with this problem? And started to just investigate what could be done with the problem, looked at working for carriers, hospital systems in the finance department to see if that would be a route where you could really understand the scope of the problem, and learned that it would take a real long time to actually understand the scope of the problem while working in one of those kinds of positions. So looked at becoming an analyst actually for a benefits consulting firm, went into work there, and they said, hey, you know, you don't have any work experience. All you've done is coach college football. That doesn't count. But they said, hey, you got a good personality. You should get into sales. Of course, we won't hire you, but here's a couple other people to talk to. So I became a benefits consultant full-time in 2014, just started selling BUCA cases, level funded cases, wrote my first self-funded case in 2016. What we did was we were able to carve out a PBM on a large construction company, and they were really getting blitzed with the specialty med utilization. So we carved out the PBM, actually installed script sourcing. Funny enough, I didn't even know Gary at the time. And we were able to keep them from an 80% renewal all the way down to a 10. And that just sparked a light in my head, and this is the way. This is what every group needs to be doing with their benefits. And I actually started to do it on two of my other groups. I almost got fired from my firm because in Colorado, you know, there's a specific BUCA carrier which runs the market, and you're not to take business from them because it would have affected our bonus program. So I became a benefits consultant, broke off and did my own thing with my own shop, put a ton of cases on reference-based pricing, which was really successful for about 12 months until our two largest health systems said, we're not going to accept RBP in any way, shape, or form at all. So we really morphed to more of a managed care model that I learned while doing referrals in my mom's primary care office of prior authorizations to move care to bundled type surgical imaging, et cetera, because that's how the Medicare Advantage plans function. And using independent networks, that's what we really moved the model to. And I met my business partner, Dylan, back in 2018, and he was working in the business in 2020 when we decided, like, let's go wholesale this out to other benefits consultants. And the vision for it was, how do we make this as easy for a benefits consultant to sell and deliver next-gen strategies as a BUCA product? And that was really the goal with Excel Health Plans, was to deliver a BUCA-like product in a stack that's as easy for you all to deliver as National General, Aetna Funding Advantage, those type of products. So that was the vision, and that's how we came up with it. And we've been blessed that we launched in the beginning of last year with the product in full. We were basically beta testing in 2021, and we've had a great year of growth, and a lot of our partners are here in this room. So thanks you guys for all your support and putting business with us.
It's awesome, man. I know that ride, just listening to it is wild. And it's interesting, you touched on a little bit about just the funding strategies. That'd be good if you don't mind commenting on them. Just when you think about the funding strategies in level funded plans, there's a lot of interesting things that can happen there.
Well, I think it is very interesting. Just utilizing the term level funding plans creates so much perceived simplicity and yet no real definition. So we try and avoid that and just talk about self-funded plans and how they're funded. You can fund them at the max, or you can fund them at some expected levels. But generally in the small group market, people are using that term level funded to suggest we're going to fund these plans at the maximum so that we know the employer never has to come out of pocket. We never have collections issue. We don't have a terminal liability issue. Everything's funded with extended claim settlement options. But one of the things that I think many of us miss is that there's even more than you can do than just making the plan easy for the employer. You can make it more effective. For years, I sold health reimbursement arrangements side by side with self-funded plans. And a couple of brokers asked me, why would you sell self-funded HRA on top of a self-funded plan? Why not just build the benefit better? And believe it or not, it actually works because of the mathematics of the specific deductible and the HRA deductible. And so as technology has improved and as other vendors come into the marketplace, we can actually get more flexible even by layering a MERP, or a medical expense reimbursement plan, another self-funded plan on top. Different set of regulations. We can work within, a little bit more flexible than an HRA. And so you can get very creative in how you fund these plans, even staying within the parameter of the self-funded plan you build. Maybe move it to a higher deductible, offer a couple of different options through a MERP or other type of creative funding. And ultimately, the more of that type of thing you do, the more you yield savings.
Yeah, I think it's interesting. I had a conversation with somebody yesterday about the same subject. I've put level funded plans in place, and you think of a bell curve. You got 20% of people at the bottom, 20% of the people at the top. These plans that you guys offer, they 100% apply to the biggest market, and I think that's what's so interesting. The fully insured people are saying that that's what they do, and it's not the case, because you can use some of those strategies that you're just talking about, and it really makes a difference. So I appreciate you sharing that. Micah, back to you. What do you think's causing the growth and kind of towards that? Just the amount of people this applies to. What do you think is causing that growth around Nextgen and some of the things you guys have shared?
Yeah, that's an interesting question, Daniel, but I would say the biggest reason for the growth is economic, first and foremost. Companies are really facing downward pinches that they haven't in the past decade in terms of really low unemployment. As we see, cash is not as easy to get your hands on as it was 2 and 3 years ago, as well as just the overall economy is not booming like it was a few years ago. So companies are much more conscious of where and how they're spending money. And I think that primary driver is the biggest reason that these next-gen style plans, probably as a whole, are being adopted so quickly compared to what they were, is because the companies have no choice. You look at the cost of an individual insurance plan in 2000, you could buy an individual insurance plan for less than $2,000 a year. Now you can't buy one for $10,000 a year. So when you look at 5x on a price and apply that across how much it pegs employers in the wallet, they don't really have any choice. And I think there's a lot of benefits consultants, even from some of the consulting houses, where they're looking at, hey, am I going to lose my property insurance client because I can't find a way to offer them a more affordable benefits strategy? And I think that economic pressure is working its way up, and that's the primary reason for the growth. That, and from our side, we just really try to make it simple to sell without individual health questionnaires for the consultant. So the dual purpose of the simplicity and the demand is what's causing the growth.
I think I've got a slightly different take on that. I think the real driver in this growth in small group self-funding, having done it for over 30 years now, I've seen this change of the marketplace, and you continue, and it's always an education battle. But the real driver, I think, in recent years that we've seen is the changes in the ACA regulations and legislation. When it first started in 2010, and we're slowly implementing over a 4-year period the development of the ACA regulations. Then the carriers get into that, and then they start to see, number one, we can't underwrite anymore. Number two, we're community rating or modified community rating, so that restricts what we can do in our premiums. And number three, we have this massive risk adjustment mechanism. So as we start writing more and more premium, we've got to give the state $15 or $60 or $70 million back to distribute to other carriers in the same marketplace. So then the BUCAs start to play games and create these self-funded plans that are questionable in many cases. Certainly they have their own compliance departments, and I'm sure they've vetted what they need to do, but they really are often referred, even by the BUCAs, as a mock-up of a fully insured plan, put on a self-funded platform so that they can get around the regulations and they can go back and do underwriting, and they can avoid the risk adjustment mechanism. So in recent years, since the passage of the ACA, you've seen the BUCAs jump in on this side, which they, prior to that, had really, really resisted. Right before the ACA, you didn't see the BUCAs coming out with that type of thing. Now, as it progresses, as rates continue to escalate, even during times before the economic downturn, you started to see the self-funded markets in that small group arena continue to grow. So I think you have to really look at the market is still driven to some extent, or the adoption has been driven by the BUCAs, which kind of helps the rest of us because now people are familiar with it and they say, oh, I've been self-funded, I can keep doing that.
Yeah, it's a great point. It's a great point. And you talked a little bit about, just to let you kind of unravel a little bit more, you talked a little bit about just how premiums have gone up. One of those big ways is on pharmacy, obviously, especially when it comes to specialty pharmacy. So it'd be, if you don't mind, touch on that a little bit and just how, what you're using to kind of go after that stuff.
Yeah, pharmacy, I think we all know we got a lot of pharmacy solutions here. I mean, so many PBMs here, and we were using the specialty pharmacy techniques as well. And I think the real key in pharmacy is you really have to focus on that fiduciary PBM. No pass-through, great clinical management is really important. We left this Cigna PBM a number of years ago, probably 5 years ago, after we realized just how obvious it was that they were more concerned about selling prescriptions than they were controlling costs. And it became blatantly obvious. And within days after the switch to USRX, we saw things that just blew everybody's minds. We would get a call from the owner, hey, I've got a $700 prescription that Cigna's been paying for years, and now this new drug vendor you brought in won't pay for it. Well, that's because there's a $35 generic. The exact same chemical composition, the exact same prescription, it's $35. The employee has no copay now, and we just saved you $700 a month in funding for the plan. So that transparency combined with the clinical management to actually impart and get the communication in line with the physician and with the patient and make sure that that generic substitute is the appropriate direction and is authorized by the physician and get that done. So you've got to look at not just the pass-through concept, the fiduciary concept, the specialty and what we do with companies like script sourcing, but in addition to that, you really got to look at that clinical management and the outreach to reach out, get a hold of the docs, make sure we can make those transitions. Because if the doc doesn't say okay, you still got to battle.
There's just, it's so crazy how much, you know, being newer into the business, just the gap in what you can get those kinds of drugs for versus what they're being charged for today. It's just mind blowing how much money is in that. They talked about it a little bit, you know, 2 sessions before this, and it's just such a wild scenario.
Well, I go all the way back. You probably don't even know the name of the company, but I know a number of my associates out here know PHCS, which used to be just a pharmacy card. Remember, it was a convenience item. It wasn't about pharmacy benefit management. It was just they built this network to tie all the pharmacies in so people didn't have to have their drugs go to that process of submitting the claim to their deductible before they could get reimbursement. So it was just an ease of transaction. And we used to have this little logo on all of the pharmacy windows, and if they didn't have that, then it was trouble. So this was just easy. And in those days, pharmacy cost was 9% of the whole plan. And it was kind of an afterthought to have just layer this convenience in so people can get the prescriptions without the deductible. Right. Now, today, what we've found is they've turned it into a cash cow. And the PBM, they should drop the M off the end and just call it pharmacy benefit sales instead of management. And so there's a big difference today.
Yeah. And Mike, I know you've got a whole, the two of us have talked about this subject a ton over the last 6 months. Probably more calls than you care to mention, honestly. But a lot of it was because of where you kind of started in with Excel on the level funded side. So talk about that. Why do you think it's such an important option to a broker? I mean, I went through that with you personally, so share a little bit about that if you don't mind.
Yeah, that's a great question. So the most important reason why a level funded product is a big deal for a benefits consultant is to push that easy button. As we all know, it takes a ton of work to go pull together a next-gen style plan. You got a 1,000-life client, and you want to go put together a custom vendor stack, you're really looking at a very long run-out time, 3, 4, 5, 6 months, to be able to install that really well and make sure that the open enrollment and the education roll out smooth. And especially if you're going to put reference-based pricing on that stack, it's going to be a really long-term process versus a plan that's level funded and pre-packaged is going to allow you to sell a lot faster. You know, we work with a number of benefits consultants who had barely done any next-gen style strategies and had $5, $7, $50 million books and had a lot of pain installing these strategies. And now numbers of them have put 1,000 lives on self-funded strategies, 10, 20 groups, because they have something that they can go out and they can just sell. And then they can rinse and repeat and go out and just sell. And I think that's the biggest advantage, is that most benefits consultants either just want to go out and be salespeople, or there's going to be a certain line below which it's not worth your time to go build a custom self-funded solution. And these plans like BIC and ourselves fill a market need where we can function as both of those for both of those types of benefits consultants.
Yeah, that's true, Mike. Mike's absolutely right in that it's virtually impossible for you as a broker to think that you're going to take that 17-life employer and go out and negotiate individually with a stop-loss carrier to get the right rating decrements for your fiduciary PBM and for your managed care technique and for all of the things you do in reference-based pricing or anything else. They're going to laugh at you. You know, a typical stop-loss carrier at 17 lives is saying, here's your book rate, and we don't really even want it. So by combining those blocks in these turnkey packages, that's how we're able to really drive that economies of scale of the 1,000-life employer down to a 17-life employer.
Yeah, and I think, you know, just to add my 2 cents to it, like my background's in tech. I was in the tech space prior to coming into this, and having a off-the-shelf option where it's prepackaged, it makes it replicable, like you're saying. Well, if my goal is to grow the business from a healthcare perspective, I want something that gains me clients as fast as I can so that I'm growing and I don't have to change up a bunch of things or move a whole lot of things around to make that happen. And so that off-the-shelf option, you know, I don't know if that term's necessarily used in this industry. Haven't heard it outside of me say it, so probably not. But I think that piece of it is crucial just from a broker side, because you're not driving yourself crazy on the type of account that you were just talking about. You talked a little bit about this earlier, but I think coming back to this, it's just on the other side of the same kind of question. What do you think the members, when they get into these kinds of plans, they want to do things differently, they're trying to be innovative? Talk a little bit about kind of their interaction with it.
Well, see, this is one of our biggest challenges, right? How do we make the member want to participate in these new initiatives, right? I mean, force feeding it is one thing, but how do we really turn that table around and get the employee to want to play, want to go to the right directed care, want to go the right direction, get the savings, get the ITR benefit? And you've got benefit incentives based on your plan designs, but you also have to have a tremendous level of communication and education. So I think it's really important to try and engage at that member level, because if they don't want to do it, then all it takes is the slightest little problem for them to blow up, right? Anytime you're asking them to do something and they don't like it. So I think that's all of our challenges and what we continue to do. I think technology, I'm not as big on gamifying as some of the bukas are. They think gamifying your app and making it fun is going to drive people to have more fun with their healthcare. I think that's a load. But I think the reality is you do have to give them some means. And frankly, the easy is the part. Mike said it earlier about got to be easier for the brokers to sell. Well, it's got to be really easy for the members to use. And so I think that's our initiative is now, our current initiative this year is really working on those tools that we can apply to make the member's job easy to navigate, easy to understand, and so that following the path to low-cost healthcare is really easy instead of a nightmare.
We got a few more minutes, Mike. You want to comment on the same kind of thing, what you're seeing from a member's perspective?
Yeah, member redirection is is tough, and that's why we focus on aligning incentives for members. So it's very important that the member have a reason to go one place versus another. For our plans with managed care, Medicare Advantage sort of as the model, it's just a requirement. And if you look at traditional HMO plans, that's how they function, is it's, hey, you can go to this provider because we like the rate that we're able to pay there, but you can't go to that provider. And rather than functioning in that manner, we just create an economic incentive in that decision to the member in saying, hey, we have a preferred provider. They're at a Coral bundled location. We can get this ACL reconstruction for $7,000 instead of you using the network inside the hospital and getting it for $33,000. And if you're willing to make this decision, you won't have to pay anything. And that is the strongest driver for a member who credit card debt is at an all-time high right now. People don't have a lot of cash on hand, so saving $2,000, $4,000, $6,000 is meaningful for people right now, and we're seeing members take it. And that's been probably the most critical part of our success in member management.
Awesome. You got 1 minute if either one of y'all want to share anything else that stands out. I know you guys have taught me a whole lot, so I'm just wanting them to have that same kind of
I think following up on Mike's comment, I think it's true that this incentive to the employee is really strong. And that's why I'm also enjoying some of the newer technologies we're seeing in cash pay vehicles, and ability for the employee to pull out a card that his employer has given him. The employer's TPA or the plan manager can authorize a payment of cash to the physician on the spot so they can get the best cash pricing there and resolve some of those access issues at the gate as well. So those are some pretty neat continued innovations that we're seeing in the marketplace. And as we refine those as an industry, I think we're going to be far better off. I've said for 25 years that I just can't believe that the largest claims administrator in this country isn't MasterCard or Visa. You know, they're attached at every single point of purchase. They could be the kings of TPAs, but they've just never taken that on. So what we have is an independent industry, cottage industry here, where our tech firms can embrace that Visa, MasterCard technology and start applying the same advantages into the healthcare world, even though MasterCard and Visa didn't take it on themselves.
Well, everybody, Mike, Roger, thanks for sharing with us the two talks.